Today we're discussing one of the most interesting market environments that we have seen in years.
Welcome to Market Boys. I'm Andre Sanchez. My friend here, Xzabko Scott.
How's it going, guys?
So, what we have today, Xzabko? A lot of info, huh?
Well, a lot of info. We are in a changing times, and it's exciting times. I'm ready. I don't know about you.
What changes?
I'm ready.
Every day is a change, so that's true.
Today we're discussing one of the most interesting market environments we've ever seen in years. The stock market continues reaching new highs. Of course, artificial intelligence continues driving investment dollars up and up and up. Or
everything is up.
Say, blowing the bubble.
That's right. So yeah, I mean, like, it's record heights, right? The S&P 500 raise hit 7,600 points. We're gonna get a little bit of data for you guys. Also, inflation kind of like remains stubborn.
Yeah, it has been, and it just continues to rise, unfortunately.
So, you know, guys, the economy remains resilient, right? As we talk about, inflation also remains stubborn, which is creating kind of like crossroads for us, right? Because if interest rate remains elevated, right, and oil prices are climbing, and some Federal Reserve officials are even discussing the possibility of future rate increases. So the next couple of weeks, we're going to see a lot of stuff, some data that's coming out.
That's right.
They're not a tough position because 6 months ago, the discussion was like, okay, can we lower interest rates, right? Are we on the position? And they just hold back.
Right.
Now everything is up. How do you
navigate?
How you slow down the train without derailing the train?
Indeed, and that's something for the government to definitely attack. Right? Attack Donald Trump.
That's right. So the question today is simple. Is this rally really sustainable? And more important, what should investors who are approaching retirement be doing right now? Because that's the $1,000,000 question, right?
Right.
Because in your 20s, in your 30s, yeah, I mean, you still have a long way to go.
A lot of time.
It's very critical when you are approaching this or transitioning from accumulation phase to distribution phase.
And that's always like the conversation, isn't it? Right around that age, it's like, okay, I built my fortune, or a small fortune, if you will, for retirement, and now I have to go into protection mode, right? Not survival. I mean, survival mode and protection mode. It's like, what do I do? Where do I put it? I can't keep it under a mattress.
Right. How do I do it, right? I don't want to get out of the market. I don't want to put everything on the mattress, like you say, right? Or just keep it on the bank account, devaluating, especially with the cost of living these days. So it's a paradigm, right? Or crossroads for most people. So let's jump in, right? So first, the market continues to climb, right? We already know that the market continues to surprise investors. The S&P 500 is near the record highs, guys. So right now, they hit 7,600, and the Nasdaq continues to outperform everything, right? Right now is approaching actually emerging markets, which last year emerging markets were around 31 to 33%.
Right.
And I was looking at some data from Franklin Templeton, and right now in 1 year, they're up 55%.
55%?
Emerging markets.
Wow. 55%. That is huge. Or is it?
Yeah.
To some people it is. To me, that sounds like a great number.
Absolutely, right? So, which historically they don't outperform the American indexes, right, or the economy. Sometimes they do, but this is a very impressive number that they have achieved the emerging markets. A little bit of everything that is going on, right? From the trade war last year and tariffs and things like that. Now going with oil, it just
and the emerging tech. markets
Yeah.
as well.
So technology, right? You just mentioned it. Technology remains the dominant sector, guys. It's just going out of control, or just the new heights. It's just the new economy, right? And despite geopolitical uncertainty, inflation concerns, and the high interest rates, investors keep buying it, right?
That's right.
They keep
That's right.
putting money like crazy into this.
Yeah. I mean, they have no other choice, right? You have to feed the beast, and the beast is hungry, right? So what is fascinating is that the market is no longer being driven by rate cut, right? Expectations, right? And so for most of 2024, 2025, investors were asking, when will the Fed cut rates? Today, the conversation has shifted,
Huh.
right? And so it's important to understand that, they were changing chairs too, right? The Feds were changing chairs. So, implementation of a new, of emerging times has shifted because of that too, right? So decisions are going to be a little skewed in the beginning, of course, right? Now, I don't know how significant that is, but I think it has some significance, right?
Yeah,
They're doing some
sure.
evaluating. Now investors are asking, can corporate earnings and AI growth continues to outweigh high interest rates?
Interesting, because I remember back in January, right? January, February, the $1 million question was, can AI deliver to Wall Street? Can AI deliver to the investors? Now, the question is
Yes.
it was proved, right? Now, the question is where do we found the energy resources
Huge.
to maintain these bees, like you said, feeding this animal
Right.
to what it needs to?
Right. Because now we're tapping into resources for our own survival, right? And cooling these machines, it takes a lot of energy and a lot of resources. So what is the expenditure of this, and how much is going to cost us in our day-to-day, right?
I know. I mean, I was sharing with you that before we started the show that I was doing one of the studies, and he just when somebody goes on OpenAI, right, asks a question, every time that a user asks an agent a question, right?
Right.
Agent seeing the person, the ChatGPT source, it consumes around the amount of energy that is proportional to a light bulb
Right. I remember you saying
on
that.
for 3 minutes. It's one question.
And we have tons of questions. Have you seen there was a video, it's funny you say that, because it's funny, that math, right? And time versus energy. There was a video of a young lady, a realtor, right? It's a realtor joke. And she's showing a house. And the woman that is looking at the house, was asking ChatGPT everything about the house while the realtor was showing it, right? So she was like, the realtor was like, yeah, this is wood floors. And the girl was like, Chat, is this wood floor?
That's funny.
And ChatGPT said,
Nope.
Yes, it is it's wood floor.
Oh, yeah, you replied? Okay.
And so we will ask, even though we have a source right in front of us, we will still use this source when we can just answer a question ourselves.
Yeah.
Right? It's right
Well,
in
it's
front
not
of us.
yeah, I mean, you're going on the tangent of critical thinking, right? Because the brain is a muscle, you need to exercise it. And when we have a computer that is doing all the processing data for us, we stop processing data. We became
Exactly.
codependent on that.
Our mind is going to get lazy. So,
Right. AKA, we become stupid. That's what I was trying to say, right? Simplify it.
Indeed. So it's okay to observe on
Right.
your own.
Correct. And ask critical questions. You should be able to challenge the machine,
Right.
right? And question. Actually, when there is a prompt called Socrates. So when you go on OpenAI and you put Socrates, right? It's actually gonna give you information, but it's gonna challenge your thinking. It's gonna ask you questions too.
As it should.
And it should be, right? Well, should be. You should learn how to talk to the machine, talk to the prompt,
Right.
how to educate it, because it's like a baby, right?
Exactly.
It will just spit out information.
It's learning everything from us. So it can create based on the variation of things that we have taught it. So in order to learn new things, we have to teach it. We have to teach it the new things.
And the other thing that, are you familiar with quantum?
Yeah, of course.
All right, so for you guys, so normally all the computing systems that we have, right? Everything that the language that runs on bits, right? Ones and zeros, ones and zeros, ones and zeros. Every single program, until today, even OpenAI, all these things are still running ones and zeros.
That's right.
Now, quantum computer is different.
Brings them both together.
It doesn't works on bits. It's qubits. So it's not ones and zeros anymore, right? So you will have one agent of ones and zeros. Now it can correlate those two zeros or those ones. Very important. So it works the zeros and the ones at the same time,
Exactly.
instead of like being a unified element. And this ability, what they call it, is supervision or superposition. In other words,
Superposition.
right? Superpositioning. So superposition is very interesting, but because it opens alternate things to how the machine process data. So let me put it this way, because I don't want to get complicated. Right now, quantum computing or quantum machines is on the stages of the equivalent of computers back in the 1950s, 1960s.
Yeah, the entire
so
room.
we are like in
Servers.
that. Remember that punch card? That's how new it is and how green it is.
Right.
But it's unthinkable.
And it required like an entire warehouse filled with these
The
these
amount
computers.
of energy, yes, the amount of energy that it sucks in, it's incredible. It's scary, right? So we might need some solar.
Well, you
Consumption?
know, it seems like NVIDIA is starting to solve that problem. They're making these chips so small. They figured out an AI chip, right? So, you know, and this thing is tiny, and they're putting it into computers. So an entire AI computer. So we're going to have access to quantum computers here pretty soon. And let me tell you, are you ready?
I know. Because the traditional computers and those chips that you're talking about, they consume information one at a time, right? With quantum, it's multiple informations
And-
at the same time. So the amount of energy is exponential. The consumption of the energy is also exponential,
Indeed.
right? It needs a lot
of energy. A lot.
So did I say
And-
energy again, right?
Energy. Oh, let's not talk about, and you know,
So that's why when you see, let's going back to the market, right? When you see these tendencies, right? AI is up to all-time high. Semiconductors, energy, right? It's
computing power. Yeah.
it's pulling the market up, right? It's what driving everything else. Now, so far, the answer has been yes to the AI boom, right? Now, corporate earnings have remained very strong. Consumer spending remains healthy as well. Employment remains relatively stable. And AI spending is exploding. Things to digest, right?
A lot.
So what we are, I
But
want
not
to share some
hard.
information.
I mean,
Yeah, go ahead.
It's all relevant. You know, as long as you study what's happening, you pay attention to what's happening, and you take an initiative to what's happening, you should be okay, because it's fairly brand new still, right?
Yeah.
So you're not too late to get on the bus, right? So to speak. So to speak.
So I want to share some because I had some data here. So latest data. So we have this. This was as of Friday. So we're on Tuesday right now. These numbers are already outdated. But S&P 500 closed on Friday 7,580. Now it's at 7,600. So I already reached one of the economists. JP Morgan expectation for the 2026 was 7,600. the S&P hitting, the market already achieved that today. Dow Jones closed at 51,000. So the S&P 500, it's this year up 11.3%. For the year, 29.8, already hit 30%. Dow Jones, 22.7% in a year. This year has been up 6.9%. That's the industrials, right? Those are the slow
Healthy
ones.
growth.
We'll see. NASDAQ, 42% in 1 year, 16% year to date. The Russell, the 2000, let's go with the 2000, is 43% for the year, and year to date is 18%. Emerging markets, 55.2%, and year to date is 25.7%. Brutal, right? Now, energy continues to be the sector that is driving equities big time, 26%. Information technology, 23.8%. And industrial is at 12%.
Okay.
Huge difference, right?
Right.
I mean, it's double between industrials and anything with technology.
Right.
Twice as much. On the financial sector, like the bottom ones, financials and healthcare are devaluated up. They're negative 5.3% financials, and healthcare is around 3%. Now, consumer discretionary is up 4.1%. So financials and healthcare, which had most of them has good balance sheets, good financials, but the market has pretty much discarded them. They don't want to. It's not attractive to the market per se. Good data, inflation 2.8% remains at the core, CPI core, and unemployment remains at 4.3%. Friday, non-farming jobs data comes out. So that's going to be a tricky one in the sense that if the data is positive, creates inflationary problems because most likely they're going to need to increase interest rates. And if it's...
gallon of milk is going to turn to $10.
Something like that, right? And if it's the opposite, the data is not good, right? That means that we need to start decelerate the economy. So, not a good position to be, right? So, cross lines, right? Or crossroads, you want to call it.
Well, now.
So remember, guys, AI is no longer the future. It is the present. That has been confirmed.
That's right. Artificial intelligence continues to dominate Wall Street as it will continue for the next foreseeable future. Companies are investing in billions of dollars into AI infrastructure. Now, that is the most important part about it, right? So this is what is exciting, the infrastructure. It started from the ground, and we might want to get involved, right? We might want to pay attention to what's happening in that area. The race is no longer about who has the best AI. It's about who owns the roads, the bridges, and the power plants of the AI economy, which I was just, of course, expressing, right?
Yeah. I mean, like the gold rush, right? Remember? Well, I don't remember because I wasn't
Get your shovels and your bucket.
Yeah, the people who made the money, it wasn't the ones who went to strike the gold.
That's right.
The companies who made the money were the ones who were selling the shovels, the picks.
Indeed.
Okay? They make a fortune out of it. Markets are always evolving. We are all-time high, as we mentioned, but this is a call for caution as well, right? So, as we know, think about the California gold rush, as we just mentioned before. Most miners never became wealthy, but the people selling the picks, the shovels, and the supplies often did. Today, AI infrastructure, right? Those companies become the picks and the shovels of the digital economy. That's what they are.
Indeed. Companies are spending enormous amounts on data centers, semiconductors, cloud computing, and energy infrastructure. The demand of computing power continues to rise.
Yeah. In addition, guys, this is why many analysts believe that we're still in the early innings of the AI revolution, which it's accurate per se, right? I mean, like the .com bubble, right? Internet,
right?
First stages of internet, yes.
It's going to have its time.
But There's no guarantee, or there is not. All of those names that we are hearing today, they're not going to be tomorrow.
Right.
That's the other thing. So, however, that doesn't mean investors should ignore the risk, correct? That's what we're actually calling. Because every major innovation cycle eventually experiences corrections. It needs to happen. It's healthy. What is unhealthy is not to experience a correction.
Indeed.
Correct.
So it has to be made. Drawbacks are going to happen, right? Increases are going to happen, and a decline will happen.
So technology, guys, creates opportunity. Valuation creates risk. Wise investors also understand the difference, which most of the time Main Street doesn't. They just go with the hype.
Well, emotional. They become emotional.
The other part is the Federal Reserve, the wild card, right?
One surprise this week came from Federal Reserve officials. Some have suggested that if inflation remains stubborn, high future rates increases remain possible.
Think about that for a second, right? 6 months ago, investors were discussing rate cuts, Xzabko.
Right.
It's like, okay, how are we going to have some rate cuts coming up? Today, some policymakers are discussing potential hikes. What is the impact, right? What is going to be the impact into the economy?
This has happened before, right? History don't repeat itself, but it rhymes, right? And a lot of people are comparing it to the '08.
Yeah. So remember, that tells us the inflation remains a concern. Okay, guys? Very important.
High interest rates affect everything: mortgages, auto loans, business borrowing, real estate values, and investment valuations.
The market doesn't necessarily fear higher rates. What it fears is uncertainty. And right now, uncertainty remains elevated.
Yeah, extremely elevated.
Now, the other part is the job report that everyone is watching. This week, employment report might be the most important economic release of the entire month.
Because we're looking for Goldilocks economies, right?
Yeah, not too hot, right?
Not too cold.
Yeah. If the job growth comes into a strong, inflation concerns rises, guys, right? And if the job growth comes into weak, recession fears will increase.
The market wants steady growth. That's the sweet spot. Always. We want to be able to see the market stay in a bull run and remain there when that is not the case.
Yeah, sure. Yeah, I want to live forever. Yeah, it doesn't work like that, right? There is a beauty in pain. There is a beauty in corrections. There is a beauty on that balance between light, like day and night, right? Light and darkness. There is balance. The humans is still trying to figure out and understand.
It's funny to touch on this a little bit more further, right? Is a study on crows, right? So when a crow see one of his crows fallen, right, deceased, it shouts out to the other crows to come out. And so they have this funeral, pretty much, right? So they have a crow funeral. And what they're really doing is they're learning. They're paying attention to the environment. They're looking at how potentially the crow may have passed, but they're looking at what could have caused it too, right? And so they're learning how to survive, right? And I think that's where the hard times come from. We analyze what created it, and then we learn how to, if not prevent it, survive.
Interesting. I thought they would just come and eat them. They got to eat
That's
them.
originally what I thought.
Right.
But they were having a funeral. And they were learning from the environment what caused it to happen. It's interesting stuff.
Wow. Now, the next segment goes to oil, geopolitics, and inflation, right? It's getting better. Oil prices remain elevated due to ongoing tensions in the Middle East, which is right now becoming like an old book.
Indeed.
Right?
Many people who don't realize oil affects almost everything. Transportation, food, manufacturing, travel, especially travel, utilities, and so on.
Oof. Yeah, I mean,
Right.
everything, pretty much.
The cyclical, right? Cyclical.
That's why energy prices often become inflation prices. Let me say that again. That's why energy prices often become inflation prices. And inflation directly affects retirees living on fixed incomes. They are the ones who are feeling the most pressure right now.
The most, and Social Security being one of those factors. It's supposed to be supplemental, but you have people that live solely on social.
Right. Which this is going to bring us to the question that many of our listeners are asking, right? If the market is at record heights, what should someone close to retirement do?
Well, I have an answer. I'm sure you have an answer as well.
Everybody has opinions, right?
Yeah, I guess that's a soft way of putting it. Opinion.
So, what you got there?
The retirement opportunity most people are missing is...
What is it?
They may be... this may be the most important part of today's episode. Many investors have spent decades accumulating assets, but retirement isn't about accumulation. Not at all.
Very important.
It's about preservation of distribution.
That's correct. Let's ask a simple question, guys. If you are 62 years old and planning to retire in the next 3 years, is your biggest risk missing another 10% market gain or losing 25% right before retirement?
Yeah, we don't want that. But it's a possibility. Most people answer that question very quickly. The closer you get to retirement, the more important risk management becomes. Sequence of return risks.
Yep.
Of course.
Is one of the greatest risks retirees face is called the sequence of return risk, Xzabko. Pretty much imagine retiring with $1 million, right? You're about to retire. The market drops 25%.
Right.
This is an example, right? Now, you are left with $750,000.
Right.
And at the same time, you withdraw an income. That combination can permanently damage retirement income, Xzabko.
Indeed.
Because it puts so much stress on the portfolio that you are withdrawing income while the market is giving you losses. So it's just like bleeding out and double down on that
Double
bleed.
negative.
It doesn't help.
Not at all. The danger isn't just about decline. It's taking withdrawals while the account is recovering.
It makes it a lot harder to recover.
Absolutely.
Correct. So that's why timing is very important, and segmentation of that timing. If you're in your 20s or 30s, yeah, the market correct 25%. You still have time because you're not touching. You don't need that money. You give the time
To grow.
space to do his job,
The compound.
right? And work the compound back into that. Now, here comes the opportunity, right? And it's how we mitigate that risk, how we balance that risk. So if there is a correction, I can give time to my portfolio to recover, but at the same time, I'm not delaying my retirement because I'm retiring at the wrong time.
Right. Right.
So there are a couple of things that can help, right? So let's talk a little about an old vehicle that is very traditional. There's some fixed accounts, right? They are there. I think they're called fixed. Some of them are fixed annuities. So some of you might be familiar with them, with fixed annuities. Is one area receiving renewed attention is the fixed annuity market, guys. Today, many fixed annuities often guarantee interest rates that are significantly higher than when the retirees saw just a few years ago due to inflation.
But of course.
So today, that's why when money is expensive and inflation is high, interest rates are high, it's a great way to refinance retirement.
Absolutely.
And reposition some of that into the fixed income area, giving you more guarantees.
And protection.
That's right.
For investors who want stability, predictability, and principal protection, these products may deserve a closer look.
That's right. And let's be clear. This is in all or indecision, right? Like you don't have to go to all in or nothing. You have to be cautious, right? Nobody's saying move everything to fixed annuities. No, that's not right either. The question is, can a portion of your asset be positioned to create more certainty?
That's right.
Right? How you build that little cushion.
Yeah, buffering
Right.
strategy, right?
Buffer strategies are something that also are very, very healthy in these type of environments. And a lot of firms are starting to look into some strategies that give you that cushion while you're in the market.
You took the words out of my mouth. I was thinking cushion. Another strategy gaining popularity is the buffering accounts. These strategies seek to provide participating in the market gains while often some downside protection.
That's right. Now, think it out this way, right? You are willing to give up part of the upside in exchange to reducing the potential losses. So just to give you an example, what you can do is you can say, all right, I'm going to have what they call a buffer or cushion of 10, 15%. That means if the market goes down 14%, you don't lose anything.
Right.
If the market goes down 20% and you have a cushion of 15, in reality you lost 5%. In exchange, you have a portion of the earnings. So the market swings back, let's say 20, you're capped at 15.
Not bad.
So that's what the cushion is. How much of the potential swing ups or earnings are you willing to give to preserve a swing back,
Right.
or a lower swing?
Right.
So it's help you reduce the losses, the potential losses. Many investors find that trade-off is very attractive, especially in retirement approaches. Because again, that is the timing, right? At retirement, it's very important. The allocation of portfolios. And we don't want to be in the position like 2022 where pretty much 60-40 portfolios didn't work because you couldn't find where to hide.
Right.
Stocks, bonds, whatever. I mean, it was painful.
There was very little option.
Correct.
Very little. Because recovery from 10% decline is much easier than recovering from 30% decline.
Yeah, I agree.
Yeah, absolutely. I think we all can agree on that.
So here's a question for everybody listening. Would you rather capture 100% of every gain and absorb every loss, or capture a portion of the gains while reducing a portion of the downside risk? Question for the public. Let us know what you think.
What do you think?
Actually, there is no right or wrong answer, but there is a right answer for you. It's very individual, right? How you feel, that's the
And
truth.
based on the circumstances, right? And their lifestyle, if you will. The 3 bucket strategies is a good way of looking at it, right? Or a great approach, if you will. So we firmly, right, focus on teaching about the 3 bucket strategy, and I think it will help a lot of you guys out there.
Yeah, the bucket strategy is another way to help. So one framework we often discuss, as we mentioned, is this bucket strategy, right? And it's 3 buckets. In one bucket, we put money for cash emergency reserves. It's not for growth, it's for emergencies, opportunities. 3 to 6 months, things like that of your income, be able to put that. And emergency can be being laid off, right? Or having a bad month,
Right.
or an illness, things happen.
Right.
An accident. Make sure you have at least 3 to 6 months of your reserves there. The second bucket is the protected asset designed to generate stability and income, guys. It's designed to give stability and income. And the third bucket is the long-term growth asset. Because you are established that way, you can give the opportunity to that bucket to grow and you sport a little bit more to risk because he has time. It's the least of your buckets that you're going to touch.
Exactly. When retirees know where their income is coming from, they often feel less pressure when the market becomes volatile. And I think that's a key factor. Right? So no pressure. Well, less pressure.
Less pressure, right? So, and just to close, guys, just to finish up, this market continues to reward investors, no doubt, right? AI is transforming industries. We're going through a big change on the way we do business, on the way we live. Corporate earnings remain also strong. The economy remains resilient. But successful retirement planning is not about predicting the next headline.
Of course. It's about building strategy capable for surviving many headlines.
Right on. Remember, as market reach new heights, ask yourself, am I positioned only for growth or am I positioned for retirement?
Indeed. Great question.
Yeah. When you are building wealth, growth is the objective. When you are protecting wealth, confidence becomes the objective.
And confidence comes from having a plan, not from hoping the market cooperates. Of course not.
That's right.
It's going to do what it's going to do. Call to action, right? Always.
Yeah. Always. Remember, just take action. If the conversation that we have today raise some questions about your retirement strategy, income planning, your risk management, or your portfolio positioning, reach out to our team. Reach out to us, right? There are some links below. Reach out, give us a like, please. I mean, that's how we got information. We're still in business, providing research for you guys. So thank you for listening to the Market Void podcast. We'll see you next week.
See you next week.